Hello, good afternoon. Okay, so good evening, everyone. Please confirm if you can hear me with your emoji, please. Okay, so good evening. So, how are we today? I hope we have a wonderful day at work. So, uh, today is another day. Sorry for the late. Sorry for the late Sorry for the late sending of the link. So it's just somehow crazy. But nevertheless, let us proceed and continue from where we stop. Please don't let us disturb the class. Let us mute our mic and see how far we can go about it. So last week we were able to discuss extensively about. Please confirm if you can hear me very well, please. Okay, so we were able to discuss extensively about uh, the chapter 8, which is on audit evidence. We we did justice to that because the class took us about 2 sessions to finish. We started on Wednesday last week and finished on Friday. So then on Friday we did something special, something spectacular about what we are expected to see in our exam on advanced audit and assurance and how we are expected to answer the question. So everything we were able to dish out to ourselves, and to some extent, I believe that everybody in this class or another time we are going through this video on YouTube, we class we had that day. This chapter is somehow short, so at least by 6:30 should be. Can you hear me, please?
Actually, your voice is actually breaking. We can't hear you very well.
Okay, so please, can you hear me now? Everyone, can you hear me now?
Yes, we can hear you, sir.
Someone said my screen is not showing. Can you see my screen?
Yes,
Yes, we
we
can
can see it
see.
is showing.
You can see your screen.
Let me unshare and share again. Some people are saying they cannot see my screen. Okay, so the screen, I'm sharing the screen again. So for those of us that said they can't see the screen, so here is my screen again. Can you hear me now, everybody? Is the voice okay now? All right. So let us proceed. From we are going to start from where we stopped last week. We have explained extensively on what we need to know about chapter 8 on ISA 500, which is on audit evidence. We talk about the ISA, is it 620 and 630 or 520 and 530 as the case may be on audit documentation, audit sampling and the like, the analytical review or analytical procedure rather. Then we talk about the uh, uh, related party disclosure and the like. So today we want to move a little bit from what we discussed last week. And today is centered on the evidence we collected. That is why, if you have been following my class every week, I used to tell us that the understanding of this advanced audit and assurance comes from your perfect understanding of the previous classes. I mean the previous chapters. So if you are the one that is struggling, or you've not, as at the time we are having this class, you don't understand that chapter 8 very well, it will be difficult for you to proceed or roll along with what we are discussing. Abibat, please mute your mic. Shaibu Abibat, please mute your mic, please. Thank you. So, uh, chapter 8 talks about audit evidence, how to gather audit evidence, and how we can substantiate the evidence together in order for us to form an opinion on the said financial statement. Please, anyone in this class that does not mute his or her mic, please should do so. Thank you. So, today we want to now move forward. Out of all the evidences we collected, how can we evaluate all those evidence? Evaluation in this sense has to do with weighing the evidences, whether it is up to a point where we can use it to form an opinion. So evaluation is for you to weigh the weight of that evidences you've collected. If it is substantial enough to form an opinion, then after you weigh it, then you review it. Then after reviewing it, then you can now center it on whether you are going to uh, use it to form an opinion or not. So this chapter focus is centered on evaluation of those evidences and review of the evidences in order to substantiate it and to use it to form an opinion on the financial statement. So how do we evaluate and review audit evidence? First of all, is to have a prior understanding on the opening balances and prior period comparative, which is on ISA 510. That is before you can substantiate that, oh, these evidences can be used as evidence for me. After you have evaluated and you have reviewed, you need to confirm some certain parameters, and the parameters is you confirming the opening balance and the prior year figures for you to determine. This is example of the opening balance confirmation. You know, the closing balance in the financial statement for last year will be the opening balance for this year. So we understand that, meaning that the figure that they close with in that last year account should be the opening balance this year. So one of the way to evaluate and review our evidences is taking the opening balance of previous year, which in turn has changed to opening balance for this current year. We need to confirm it. If the process of bringing the balance forward, if the nothing has changed, this is an example. For example, there might be error, like you want to open 20,000 for example as the opening balance. Yeah, then you mistakenly now put 200,000 as position. But if care is not taken, it will end up forfeit or make the financial statement to suffer material misstatement. So it is very, very important in evaluation and review of your audit evidence. You need to confirm the opening balance of the prior year and confirm the comparative. Two, you need to also understand the subsequent events. These are the events that can warrant change in the financial statement after the account has been what has been closed. For example, we have the standard that talks about it. I think it's IS change in accounting. No, subsequent events. That is event after balance sheet date. I can't remember the standard in IAS. So event after reporting date. So this thing we need to also confirm.
IS10.
Yes, IS 10. Thank you. So we also need to confirm what are the circumstances that might warrant us to change the account after the account has been what has been closed, after the financial year has been closed. So anything that can make us to change the account after every the financial transaction has been closed, we need to consider that. And we have adjusting event and non-adjusting event. Everything is still on our audit evidence and we need to or substantiate it as what as substantial evidence to form our opinion. Now, going concern, we also need to check the going concern processes of an organization. If an organization has been making loss over a period of time, it is ideal that an auditor must put this reference in his report, which is going concern. There's another paragraph in auditor's report. When we get to chapter 4, we discuss more in detail on that. So, in what circumstances can auditor put going concern paragraph in his auditor's report? So, all these things are here for us to substantiate our audit evidence by evaluating the gravity, the weight of those evidences, and review it in order for us to form an opinion on the said financial statement, whether it is of draft heavy, whether it is fairly presented, whether it's prepared in accordance with regulatory requirements, and it is free from material misstatement. So, this is what we want to talk about today. The genesis of this chapter is to weigh the evidences and to review it and consider some factors that can make those evidences we've collected not to serve as audit evidence again. So those are things we have explained to ourselves: the opening balance confirmation, the subsequent events, and going concern. So that is what we want to talk about today. So let us proceed. We need to be fast about this. By 6:30, inshallah, I want us to finish this class. So let us proceed. So everything is there for the competency, the planning, and undertaking of audit was the drawing conclusions and reporting. But let us go to this exam contest. Let us see. They said, so far, we students have largely focused on the planning and field work stage of audit. However, this section introduced the students in some depth to the completing phase of the auditing, incorporating in a number of new ISAT. At the end of this chapter, reader should be able, which is all of us here. Now, number one, describe the process and considering the and consideration for evaluating misstatement per ISA 450. So ISA 450 is evaluation of audit misstatements, evaluation of misstatements in the financial statement. So the ISA that talks about it in audits and assurance is ISA 450. That is evaluation of material misstatements on the financial statement. You should be able to describe the process and the consideration for evaluating material misstatement as per ISA 450. Two, audit planning, audit opening balance and prior period comparative in compliance with ISA 510 and 67, 510 and 710. We need to explain how all these subsequent events in accordance with what ISA 560 and summarize the concept of going concern and describe how to apply and comply with in accordance with ISA what? ISA, I think it's still the same ISA 570. So let us proceed. This is what we have today, and let us go. Like I explained before, I said evaluation is just the process of weighing the evidences we've gathered, we've collected so far, and review it in order for us to determine whether we have collected enough audit evidence to substantiate our opinion whether the financial statement is of transfer view, free from material misstatement, prepare in accordance with regulatory requirements, and fairly presented. So let us proceed. That's what we want to talk about today. And how can we evaluate these misstatements, these material misstatements during audit? as far as 450. I'm also going to explain that too before we now move to opening balance opening balance confirmation and current year comparative figures in accordance with ISA 510 and 710. So, my dear professional colleague, let us begin. My name is Olatuji Idris. Let us go. So, at this point, do we have any question from our understanding? The reason why I used to understand the concept so that as we are progressing, we definitely understand what we are going to meet later. And since I've already explained the basis to us before, and we are reading through it, it's going to open our mind further, and we'll be able to understand what we are talking about in no time. Can I proceed, please, everybody? Okay, let us go. The evaluation and review is the process where the auditor substantiates data, evidence, or analysis, or analyze the information and the impact of such information on the financial statement. The analytical procedure may be used at the stage of at the stage of at the stage of a report to put final check that the information contained in the draft report made sense. It is at this stage the auditor will now evaluate the error in the financial statement. The error found will be summarized on individual terms like revenue, receivables, or inventory, and compare the materiality threshold that was set at the planning stage. Don't forget, it is at the planning stage we set materiality, and I did justice to that. I even show us practical this thing on which one? I think on that materiality, yes. So this act will help the auditor to reach a conclusion as to whether the financial statement is materially correct or not. So, evaluation is that process, the stage whereby the auditor will substantiate our data, our evidences, and analyze the information and the impact of such information on the financial statement. This is where we put everything together and summarize the error in something like receivables, revenue, inventory, as the case may be, and compare this threshold with the materiality set at the planning stage. So, in a nutshell, we use this evaluation process on our audit evidence to substantiate whether there is any miss of material misstatement on the financial statement. And if there is miss of material misstatement, how can we evaluate them as per ISA 450? Please, do we understand that first step before we proceed? Everyone, do we understand? Hello? Nobody's talking again. Please let me see
No,
your
sir.
emoji.
No,
Yes, we
sir.
understand you, sir.
Yes, sir.
At, okay, so let us go proceed. So, since we said evaluation of material misstatements as per ISA 450, what does ISA 450 say? ISA 450 tell us about the evaluation of misstatements, identification, or the client did not do well while preparing the financial statement, and we were able to identify it during audit period. How can we evaluate such misstatements, and how can we report it? So the objective of that standard, which is ISA 450, on evaluation of misstatements identified during audit, what is the objective of the standard? Why did the standard come into play? The objective of ISA 450 is to evaluate one, the effect of identify misstatements on the audit. Then the second one, the effect of uncorrected misstatements on the financial statement. There are two. Objective number one is to identify the effect of what? The effect of misstatement on the audit. That is, if where you're supposed to put 300,000, you now put 3 million. You know that is material misstatement. What is the effect of this material misstatement in audit? How does it affect audit? Please, that maybe I should just log the class so that all this thing will not happen. Okay, please, can you hear me, everybody? Can I proceed, please? Hello? Okay, so what I'm saying that the objective of ISA 450 is in two ways. Number one, we need to identify the effect of misstatement on the audit. That is, example of misstatement is, for example, where you're supposed to carry or put 200,000 naira, for example, then you put 2 million. You know, there's difference of about 980 or 980,000 naira. So that is huge material misstatement. So the effect of this identified misstatement on the audit, what effect does it have? Does it make our evidences to suffer? Yes, because if we did not spot it, when we gather enough evidence, and by the time we later spot it, it's going to make our evidences like we've not even gathered any evidences on which we are going to form our opinion. So the objective of this ISA 450, which is evaluation of misstatement identified during audit, is to number one to identify the effect of is to evaluate the effect of identified material misstatement on the audit. Then again, effect of uncorrected misstatement on the financial statement. Uncorrected misstatement. ISA 450 want to talk about it. Example of uncorrected misstatement. At every audit, after audit, there will be something we call management letter, or if there is any audit journal. Management letter is that letter sent by the auditor to the client stating what they observe during audit, what the company is not doing right, the effect of what the company is not doing right, and the level of risk of those things that they are not doing right, and also where they are going to give professional solution or advice to the company on how they are going to correct those things they are not doing right. That is management letter. So in management letter, for example, last year, 2020, we audited 2024 accounts and now 2025. So we noticed that the company uh, the company revenue is poorly recognized. Maybe they recognize 300 million when it's supposed to recognize 100 million. So you now this audit journal for you to correct the error, whereby you debit you shall do the normal posting and you debit the correct account and credit the correct account. So and you raise that audit journal, you put it in your audit file and you send to them. Coming back this year again, the audit journal you raise on that revenue to correct the revenue last year, they did not correct it. They did not post the correct one. They did not effect the correction on the financial statement. So thereby, the 300 naira that you said they should, the 300,000 naira rather that you said they should correct in their revenue last year still remain the same. So it is already material misstatement again because you corrected it last year and you raised a journal for it. It was not corrected by the organization. And this year again, there will be comparative figure of last year. You also compare with this year. So it is there you now find out that the audit journal you raised last year to correct this sum of 300,000 naira on the revenue were never posted. So ISA 450 also talks about the effect of that uncorrected misstatement on the financial statement. So let us proceed. You now say note that misstatement could be in amount, could be in presentation, could be disclosure or classification of an item, could be an amount whereby the amount we use, for example, where you're supposed to correct 300 million to 30 million, for example. Could be a presentation, the way you present the account. It could be a disclosure, the way you disclose the financial statements, the policies. It could be the classification whereby you go and put as uh, a transaction of expenses, you go and put it in your receivables or payables, as the case may be. So that is what we call misstatement in the financial statement. However, the auditor is expected to carry out the following evaluation procedure. So after you have understand the objective of ISA 450, then we, the auditor, we need to carry out the following evaluation process. What are these processes? Number one is to accumulate and summarize all the statements found during the audit. We'll add everything together. Then Secondly, if the misstatement summarized is material, that is, if they are substantial enough, then the auditor should decide if the audit strategies or audit planning need to be revised. So when the summarized misstatements, when we summarize together and they are material, we need to also know whether this thing we need to check and revisit our audit planning, whereby we said that, oh, you need to check the aspect of revenue very well. But when we now check the misstatement and now see that it is material, then we can now increase our materiality. Maybe from 10,000 naira before, we said we now reduce it to 5,000 naira. All is essence of all this is just for us to gather substantial audit evidence on which our opinion is going to base. Number three, all misstatements should be communicated to all appropriate management for correction. That is, any misstatement whereby we spot that you are not doing this thing right, we raise a journal and we tell the company, this is what we find out. Please correct this thing on the financial statement. Number four, if management refuse to correct, obtain reasonable or obtain reasons for such refusal, then consider such reason if it is in line with financial statement materiality. Where the organization refuse to change the correction, you ask them why. So upon their explanation, you're now going to consider if such explanation is in line with financial statement materiality or not. Number five, we'll also evaluate the uncorrected misstatement. Evaluate the uncorrected misstatement. The misstatement they said they don't want to correct, let's evaluate it. Is it substantial enough? Is it material? We also need to do that. Then number six, we need to decide whether the uncorrected misstatements are material. So if it is material, that is individually or when added together. If they are material, then what should we do as an auditor? Then number seven is to evaluate the other area to review or evaluate the opening balance and comparative figures. So every other thing, when we have checked everything and we decide whether the uncorrected misstatement is material or not, then the last one is to evaluate the area, is to evaluate other area or review, evaluate the other area to review or evaluate the opening balances and comparative figures, the going concern basis and the subsequent event. So whether we have checked everything and we check the uncorrected misstatements if they are material, we've added them together, we've evaluate the effect of uncorrected misstatements, or we've evaluate the everything. So the next thing we need to do as an auditor is to check other area. And what are these other areas that we need to check? We need to check the opening balance confirmation, then we need to check the comparative figures, then we need to check the going concern basis of the organization and the subsequent event. So the next three things that we shall be discussing, we shall talk about now, is going to center on these three things: the opening balance and comparative figure, which is in accordance with ISA 510 and 710. Then the subsequent event, which is on ISA 570. Then also the going concern basis. This is where we can now know the actual evaluation and review of the evidences in order for us to form an opinion. Please, my dear professional colleague, do you understand everybody as at this point? And can I proceed, please? Hello? Can I proceed, please? All right. Please. Okay. So let us proceed. After we understand the procedure we need to put in place as an auditor, then we also understand the objective of ISA 450, which is on effect of misstatements identified during audit. Then the effect of uncorrected misstatements on the financial statement. And the auditor has carried out the following procedure. The next thing auditor needs to do is to evaluate the opening balances and comparative figures. Then two is ongoing concern basis, and three on subsequent events. So what is opening balance confirmation and comparative, and how does it affect our evaluation and review of our evidences? Let us go. For auditor to be able to reach a conclusion on its report, he needs to be confident that number one, the opening balance brought forward in the accounting record agrees with the audited figures reported. That's what I said in the beginning. That before you can substantiate that, oh, all these figures are correct, and how to weigh your audit evidences in order for you to form an opinion, you must be able to confirm the opening balance brought forward. If the opening balance brought forward is correct, that is, where they close with 20,000 naira, they must not go and open with 19,000 naira. Or where they close with 200,000 naira, they must not go and open with 2 million naira. So you need to confirm the opening balance brought forward in the accounting record and compare it with figures in the audited report. The audited report is at least the closing balance of last year is the audited report. It has been audited already. So you have to compare it with the opening balance of this current year. You want what? You want to audit. So you ascertain that first, which is the opening balance brought forward, if it is correct and agrees with the audited figure reported. Two, whether the accounting policies have applied that have been applied consistently over the current financial year and prior year. The accounting policy where they use cash basis, they cannot just change to accrual basis this year. So the accounting policy has to be what? Has to be how do they put this thing? Has to be uh, retrospectively, that is retrospectively in accounting time is it has to follow the order that we have been preparing it. It can never be where we have been using cash basis, then all of a sudden it just change to accrual basis. So we need to check if the accounting policies have been applying consistently over the current financial year and prior year. Then number three, we need to also be confident that there is consistency of classification and disclosure between the current financial year and the prior year. That is the classification of some items whereby asset is under asset, liability is under liability, expenses is under expenses. We need to also check our disclosure of accounting policy. The disclosure in the aspect of maybe under our PPE. One of the PPE is plant and machinery. Last year they used 20% to depreciate it. They cannot change to 25% this year. It has to be consistent on that. It has to be consistent like that. You cannot use 20% to depreciate plant and machinery last year, and you are using 25% this year. It is not done like that. So all these things are there to confirm the opening balances and comparative figure in accordance with ISA 510 and 710. So in the case of this, what are we going to do? What is the procedure that auditor now need to follow while we want to confirm the opening balances uh, figures? So let us proceed. Please, am I communicating everybody? Do we understand, please? All right. So let us go. So ISA 510, as we talk about, which is initial audit engagement on opening balances procedure. What are we going to do? Let's check. What are the procedures we need to put in place when we want to confirm the opening balances of transactions? So the following audit procedure, the following audit procedure are required as guidelines for auditor in relation to opening balances where the financial statement for the prior period were not audited or where the prior year were not done by the client. So this initial audit engagement, which is on ISA 510, it is opening balance procedure. So the initial audit engagement, which is on ISA 510, ISA 510, it means opening balance procedure. Please, everybody, can you hear me? Some people are telling me that my voice is cracking again. Is my voice okay now? Can you hear me, everybody? All right. So, as a fact, it talks about initial audit engagement on opening balance procedure. At what point? At what point can auditor use ISA 510, which is on opening balance confirmation procedure? Auditor can use ISA 510, which is initial audit engagement on opening balances, whereby the auditor is not the one that audited the financial statement last year, or whereby the financial statement for that last year was not audited at all. So the condition that can warrant auditor to use opening balance confirmation procedure as stipulated by ISA 510 is that condition whereby the auditor is not the one that audited the financial statement last year, or a situation whereby the account or the financial statement was not audited at all. That is where ISA 510 now comes in, which is initial audit engagement on opening balances confirmation. So what the auditor needs to do, auditor must read the recent financial statement and audit report, that is the most recent one. If it was if the account was audited last year, you need to read the audit reports for last year and to ascertain whether the opening figures are correct or not. Two, check that the prior period closing balance have been correctly brought forward. At least where that's what I've been saying. Where they use when they close with 20,000 naira, for example, they cannot go and open with 19,000 naira this year. It has to be the same 20,000 naira that was closing balance last year. It has to be the opening balance for this year. We need to check that too. Number three, check that the opening balance reflect the appropriate accounting policy. That is the accounting policies whereby they used to determine those figures. Check whether it reflects the opening balance for the accounting policy. Four, check the working paper to obtain the opening balances evidence and other specific audit procedure. The working paper that the auditor used last year, check whether the closing balance they close with is still the same balance carrying forward as the opening balance for this year. Then number five rather, if the opening balance contain material misstatement, the auditor should perform additional procedure to ascertain the effect whereby the opening balance and material misstatement. The auditor needs to perform extra or additional analytical procedure to ascertain the effect. Then number six, if such misstatement exists, the auditor should communicate with those charged with governance. That is, where the material misstatement, the auditor must communicate to the people in charge of the organization on particular transaction or particular things they find out during the review of the financial statement. That is that about the ISA 510 on initial audit engagement, which is on opening balance confirmation. ISA 510 comes to play whereby you are not the person, the current auditor, you are not the one that audited the financial statement, or whereby the financial statement was not audited at all. So, what are the things you need to do? These are the procedures you need to follow to check whether the opening balances brought forward are correct with what they closed with last year. Please, can we move on, please? Do we understand, everybody? Do we understand, please? Okay, so the second one that auditor need to check as per ISA 450 is on subsequent events, which is on ISA 560 and IAS 10. What is subsequent events? There are those events I've explained before. There are those events that happen when the financial year has closed, but those events warrant us to change some figures in the financial statement. And of course, if some figures change in the financial statement, definitely we also need to change our evidences gathered on that particular area. So what are the things we need to put in place? Or what are the things that warrant an organization or account to be changed? There are two things. We have adjusting events and non-adjusting events. What are the adjusting events? What are the non-adjusting events? Everything is going to be explained under this subsequent event in accordance with ISA 560 and also in accordance with IAS 10. So let us go. Before the auditor prepare financial statement, it is expected to examine the events that occur after the reporting date and before financial statement is prepared. Material events occurs after reporting date should be considered when preparing the financial statement for the year. So, IS 10, events after reporting date. What does it say? So, subsequent events in accordance with ISA 560 and also IS 10, which is events after reporting date. They are the same thing. So, this one says that These are events favorable or unfavorable that occurs between the end of the reporting period and the date where the financial statement is authorized for what? For issue. The events after reporting date are one, adjusting events and non-adjusting events. What is adjusting events? What is non-adjusting events? Adjusting events are those events that if occurs after the financial year, it has to be adjusted for in the financial statement. Example of this event are maybe the company is into any court case, settlement of any court case that you know that the amount is significant. Maybe they sue the company for damages of 200 million. And if this thing goes through, meaning that the company has to remove the 200 million from the financial statement and pay as damages. So if that thing later happen when the financial year, let's assume that we are in 2025 now, and we want to audit account for 2024. You know we are in 2025 now, and we want to audit account for 2024. So there's court case that happened in 2024, but they were unable to conclude it until this 2025. You know, we've not finished this transaction for the year. So it means that the transaction happened in 2024. So if there's that such damages of about 200 million or 2 million, as the case may be, and then you know that the money will be removed from the transaction of previous year, so it becomes an adjusting event. Another example is impairment of assets. When the asset is impaired, it has to be adjusted for. So these are adjusting events. However, there are also things that they are non-adjusting events. Example of non-adjusting event is maybe large fall in the value of an asset. Remember, you value an asset, then you bought an asset at 10 million. When you now revalue it, and the asset has not reached its expiration year. But when you now revalue the asset after 2 years, then you now see that the asset has devalued to about 1 million out of 10 million. And those are non-adjusting events. So if that thing happen, you cannot adjust for it in the financial statement. So these are the example of adjusting events and non-adjusting events. And also, what is the role of auditor in the case of subsequent events as stipulated by SR 550? So let us go. What is adjusting events first of all? These are events that provide evidence of condition that already existed at the end of reporting period. An entity is expected to adjust the amount recognized in its financial statement to reflect the adjusting event after the reporting period. Example may include settlement after reporting period of a court case, just like what I just said, decided before the end of reporting period, impairment of asset at the end of reporting period received after the date, or discovery of fraud or error showing that the financial statements are incorrect. So all these categories of examples, if they happen, they can adjust for it in the financial statement. Now, non-adjusting events. These are events that occurred after the reporting what period. The entity shall not adjust. The entity shall not adjust the financial statement to reflect non-adjusting events after the reporting period. Where the non-adjusting event is material, the auditor should disclose the nature of the event and estimate the financial effect or the statements that such estimate cannot be made. So what we are saying here is that there are some events that cannot be adjusted for. If they happen, the auditor needs to disclose it separately in his reports and evaluate the extent of that material and put it in his report. So the information, so let us proceed. The information should be disclosed in a note to the financial statement for necessary what decision, just like what I said. This may include a large fall in the value of assets, just like what I said. Yes, large fall in the value of assets, just like what I said. Then the other one, acquisition or disposal of some major subsidiary. Maybe you want to acquire another subsidiary, or you want to dispose or sell off the part of your subsidiary. If those things happen, they are non-adjusting events. Destruction of a major plant by fire after reporting period. Maybe one of the assets we use in the company got uh, 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 happens to catch fire, and maybe the thing lead to destruction of some property, plant, and equipment in the organization. If that such thing happen, then it must be disclosed separately in the note to the account, not to be adjusted for in the face of financial statements. So these are the conditions that can warrant uh, a financial statement to be adjusted for or not adjusted for. So I will know the example should be case of exam. So like the question we solved last week, there's question that comes under this chapter 11, which is on adjusting event and non-adjusting event. I'm sure we are also going to discuss about it later. So let us proceed. Everybody, please, do we understand? Can I proceed, please? Okay. So now we have substantially explained to ourselves the meaning of adjusting events, the meaning of non-adjusting events, the subsequent event as stipulated by ISA 560. So in the case of adjusting event, what can the auditor do? What is the role of an auditor in subsequent event? What can we do when there is subsequent event that can either be adjusted for or non-adjusted for? Let us go. The auditor is expected to plan and perform its responsibility on financial statement so as to consider all significant transactions occurring after the reporting period. The audit work does not stop at the events occurring at the reporting date only. It is also extended to the events that occur to the date till the date of issuing the financial statement. Before the issue of report, auditors will look for significant subsequent events, and after the issue of the report after the issue of the report of the financial statement, he should consider the impact of any such subsequent event that comes to his attention. So the role of auditor in subsequent event that during your planning phase, auditor has that right to make provisions for anything that can cause adjusting event or subsequent events before the financial statement is being issued for what? For publication. So then we must be able to make provisions for that there will be definitely anything that can cause subsequent events in the financial statement. And we also need to consider if there is anything that can cause subsequent events, then we should also consider the impact of such subsequent events on the financial statement. So having clearly understand the role of auditor as per ISA 560 on subsequent events, what are the procedure that auditor need to put in place to identify subsequent events? We said the role is for the auditor to make provision that there might be adjusting events during planning phase. So after that, what is the procedure of that auditor need to put in place aiming at identifying subsequent events? Number one is it should obtain the understanding of the management procedure for identifying subsequent events. That is, if there is any provision that the management has put in place whereby they make provision for subsequent events, it needs to understand the procedure. Two, you need to also make inquiry from the management if there is any subsequent events that have occurred or that might have occurred or affect the financial statement. You need to make an inquiry that do you have any court case issue? Do you have any impairment of assets that have been carried forward over the year? Auditor need to make an inquiry in order to know whether there might be any issue of any subsequent events and how they might affect the financial statement. Number three, you need to read the entity latest subsequent financial statement. That is, if there is any issues of subsequent events, as we said, in the case of the area of a court case that have been pending over the year, we need to consider that on the financial statement. You also need to read the minutes of the shareholders meeting. That is, during the shareholders meeting, after the financial year, there is going to be shareholders meeting. It is there they are going to discuss every issue that happened in the financial year when the auditor noted, and the other things that happened during the financial year. So auditor also need to read it. If in their minutes there is any discussion for subsequent events on the financial statement. So these are one of the procedures that auditor need to what to also check. Then number 5, obtain written representation in respect to subsequent events. If there is any subsequent event, then the client will also need to put it in writing as written representation that we are writing this letter to you, that there is any element of subsequent event spotted or that we have during financial year for the particular accounting year that they want to audit. So just like normal written representation that we discussed in chapter 7, written representation is that letter or chapter is that letter sent by the organization to the auditor that particular area or all the document requested for an for audit purposes has been given to the auditor. So the auditor also need to get a letter of written representation from what, from the clients that they have subsequent events, if any. Then number 5, fact discovered after reporting dates but before issuing the financial statement also need to be what? Also need to be considered. So these are the procedure that auditor need to put in place in identifying subsequent events. So the other one, where the auditor becomes aware of any information that can cause amendment, that is, after the procedure, the auditor now is aware that, oh, there will definitely be something that will make us to make amendment on the financial statement. Number 1, he needs to do the following. Number 1, he needs to discuss with the management of the organization on such a subsequent event. 2, he needs to determine if the financial statement amendment is needed, whether we need to make the amendment on the financial statement or not. Auditor need to determine. 3, he need to inquire about management intention to address the matter in the financial statement. So in the case of adjusting event, he need to also make inquiry from the management on how the management is going to address the issue of adjusting events in the financial statement. Number 4, you need to carry out the necessary audit procedure on the amendment. You need to carry out the analytical review and the procedure on the amendment of that particular financial statement. On the amendment of that particular financial statement before any subsequent event is what is done on the financial statement. Then number 6, the auditor may also place restriction on the financial statement usage and must state an in emphasis of matter paragraph or other paragraph whereby there is subsequent event. The auditor needs to get this particular auditor needs to issue a separate note in the emphasis of matter under paragraph matter in the auditor's report. When we get to chapter 4, see this emphasis of matter or other matter paragraph is going to be discussed extensively when we get to chapter 14. So then auditor needs to do this the following things where the auditor is assured or is aware that there will be any elements for them to uh, there will be any elements for them to what to adjust for anything in the financial statement. So then let us go. Facts discovered after issuing the financial statement. The auditor should do the following. The auditor needs to discuss with the management after issuing the financial statement. Then the auditor needs to determine how the financial statement will be amended. Then lastly, the auditor also needs to discuss with the management on how they intended to what to address the matter of any adjusting event in the what in the financial statement. So all these things are the procedures the auditor need to follow. The procedure the auditor need to follow where it's become aware that there will be certainly something for them to adjust for in the financial statements. Everything is spelled out by ISA 560 on subsequent events. Then lastly, going concern. This is where we are going to stop for today. Of course, this is the last part of the chapter. Please give me just 2 minutes. Let me quickly address some issues. Thank you. Just 2 minutes, please. Okay, so let us proceed. We are now on going concern now. Going concern. We are now on going concern now. What is going concern? The going concern is that procedure, is that circumstances that can warrant going concern is just normal accounting policy that we used to when we are in secondary school. All those accounting policy that we said going concern policy, this thing that an organization is going to be in existence till eternity. So in financial statement, there is in our other auditors report, there is a separate place that is meant for going concern. And going concern, where the auditor will put it there, where the what is going to warrant the auditor to put going concern as a separate place in the what in the financial statement is a situation whereby the auditor has observed that the company has been making unnecessary loss, or the company has been making loss, then the company has been making loss for a particular period of time, maybe for like 3, 4, 5 years. So, and from the look of things, the auditor can just decide that since this company has since the company has how do I put it? Since the company has been making loss for period of time now, then it is necessary for the auditor to put it in his report that we observe that the company has been making loss for this particular number of years. So the going concern base of the organization is not guaranteed. So you are trying to tell the public or the user of financial statement that, oh, since the company has been making loss for quite a number of time now, we cannot guarantee that the company is going to be in existence till many years to come. That is where going concern basis comes from. So let us see. The financial statement of an entity is usually prepared on going concern or ongoing concern basis of accounting. But if the entity is not a going concern, there will be implication on the financial statement. All assets and liability become current, and all assets must be carried at their net realizable value. That is what they are saying is that account must be prepared on going concern basis. But whereby there are some account that they just want to use it for that particular year, and the company will not be in existence again. So it means that in that scenario, all assets and liability of the organization becomes current. That is, becomes current. Current asset and current liability means that those assets that can last for a particular number for that particular year, and all assets must be carried at their net realizable what value, and there may be additional liability. So what is the duty of directors in the aspect of going concern? So in preparing financial statement, the directors, in line with IS1, IS1 is preparation and presentation of financial statements. That is, must ascertain that going concern basis of the entity is appropriate. It is the Responsibility of the management to make going concern assessment. So that is about going concern, the meaning of going concern, then the duty of directors on going concern. So what is now the duty of we, the auditors on going concern? What is our duty? The work of an external auditor on going concern status of an entity is covered by Section 570. The required this requires the auditor to assess the going concern of its client. One, if the management has performed such assessment, the auditor must, one, first of all, discuss the assessment with the management. So, the duty of an auditor is that ongoing concern, according to Section 570, it is on two way. Whether, first of all, if the management have assessed themselves on going concern basis, what should the auditor do? Number one, the auditor need to discuss the assessment with the management. Then number two, the auditor need to determine whether the assessment identify a relevant event or condition. And if so, then the auditor also need to determine the management plan to address the issue of going concern. That is, if the organization has find out by themselves that, oh, we've been making loss every year. So if the management has done that assessment, what should an auditor do? The auditor needs to discuss the assessment, the basis of the assessment with the management, then determine whether the assessment has identified is relevant, whether the assessment that makes them to know that, oh, this is a going concern basis issue. If it is relevant, then two. And number three, then the auditor needs to discuss with the management on their plan. What is their plan to address the issue of going concern problem? Then number three, the second part is where the going concern has not been performed by the organization, or where the management has not performed the going concern assessment. What should the auditor do? First of all, the auditor must also discuss the basis of that assessment with the management to be on what ongoing concern issues. First of all, the auditor needs to discuss with the management. This second part is where the management has not done any assessment on going concern basis new. Then first of all, the auditor needs to discuss with the management on the basis of going concern and their intended assumption. Then two, also need to make inquiry from the management if the condition exists that may cast the significant doubt on the going concern of the business. That is, if there's any condition that can make the company not to be in existence in the next year to come. So these are all the duties of an auditor in respect to subsequent events as stipulated by ISA 570. So, haven't we know that? What are the factors that can cause subsequent events? That can cause going concern basis. What are the factors that can make the organization to be at the brink of going concern issues? We have three factors. We have financial factors. We have financial factors, number one. We have operating factors and other factors. So, what is financial factors? The financial factors are those factors that can cause the issue of going concern basis. Number one is net liability position. When the organization is owing too much people, is one of the financial factors that can cause going concern issue. Number two, poor liquidity to meet fixed term borrowing. Poor liquidity. What is liquidity? Ability to meet financial obligation in a period of time. It is what we call liquidity. Liquidity is you converting money to cash. Don't forget that is our current ratio. Current ratio is current assets over current liability. That is, it is the ability of an organization to meet short-term financial obligation in a short period of time. That is, if the organization cannot meet the obligation in a fixed time in a long period of time, it's one of the financial factors that can raise question about going concern. Three, negative operating cash flow, where they don't have enough cash and their cash flow is always negative at the end of financial year. It is also factors that can raise a question about going concern. Then adverse key financial ratio, the financial ratio whereby on the aspect of current asset or profit margin ratio is not up to standard. That is, the indication of all these things is just showing that the organization is not doing well. It's also financial factor that can raise question about going concern. Then substantial operating loss, that is the major factor. Substantial operating loss, whereby the organization is making loss at every point in time, it is also financial factor about going concern. The last one is inability to pay creditors on due date. That is, the people you are owing, you cannot pay them as at the date you promised them. These are the financial factors, and that can raise question about going concern. The second one is operating factors. What are the things other operating factors? We have shortage of important supplies. That is, the suppliers, the things that we are using for production, we have shortage of them. Shortage of important supply that are operating factors for that can raise question for going concern issues. The emergency of highly successful competition, that is whereby we have another company in the same industry that is competing with this particular organization. So, and if that the new company, if they are strong, then they will pull up your customer. Then you start making a loss. So that's the emergence of highly successful competition. Then loss of team management without replacement, whereby you one of your major staff, you lost them maybe due to japa, or you maybe due to natural forces like death or anything. So, and you do not replace them, it's other operating factors. Labor difficulties, which is strike or riot, is also other operating factors that can raise question about going concern basis. Then management intention to cease operation, whereby the organization just feel like, oh, let us just close down this business. They are operating factor. Then other factors are serious spending on legal or regulatory proceeding against the entity. That is, whereby the organization is in court of law. Maybe they have any court case that is very, very serious, that the liability they are going to pay is huge. It's other factor that can raise question about going concern basis. The adverse effect on changes in laws and regulation of government policy. So those are the other factors that can raise question about going concern assumption. So let us go. Audit procedure. What are the audit procedure on going concern assumption? So for audit, what are we going to do? The following are some audit procedure where going concern or the firm is threatened. What are we going to do? Number one, we need to discuss with the management first, which is one of the things. First of all, we must discuss with the management on how they are going to resolve any issue of going concern for on their future plan for the business. That is, discuss with the management. The auditor should ask the management to explain the reason for the going concern assumption and the future plan for the business. Two, obtain a cash flow forecast. That is, they should give you a cash flow forecast that this is what we are going to finish with at the end of financial year. Obtain a cash flow forecast from the organization. Three, review the sales order book. You need to review the sales order book. That is, the people that is owing them, their receivables. People that is owing them, you need to review it. That is, they need to do age analysis. They should define a means whereby the people that is owing them, they will collect the money on time in order to cater for their needs too. So review sales order books. Then number four, review aging analysis. Just like what I said now. Aging analysis of receivable is that analysis that you prepare on how your debtors, that is the people that is owing you, on how they are going to be paying your money. Maybe you supply them goods now, between 2 to 3 weeks, they must have paid you your money. That is one period. Or you proceed that between now and between 1 month and 2 months, they must have paid your money. You need to review the aging analysis. Then the company litigation review. If the company is if any company any organization sue the company on any event, you also need to review the company litigation. Then information from the client entity bank. If there is any information, you need to also gather any information from the bank of the entity. That is, how many bank accounts they have, how many one is active, how many of the bank accounts is dormant, did they have loan with you, Did they do this? Did they do that? You need to also obtain information from the entity bank. So then to the letter of representation. So what is letter of representation? We have discussed about this before. So after discussing the issue with the management, the auditor should obtain letter of representation from the management, confirming that the entity is ongoing concern. So after everything, letter of representation might be in different way, maybe to confirm that the auditor's request has been supplied, to confirm that there's no issue of subsequent event, or to confirm that going concern issue has been reflected. So every alert on audit consideration in response to going concern in the current economic environment. So the ISB now see that this issue of going concern is very, very important, and organization need to be aware of it. So they now published something in 2009 that every organization need to abide with. Number one, the going concern assumption is fundamental principle in preparing financial statement. That is, they must prepare the assumption. The assumption is on that whether the company is not going to be in existence till a long period of time. They need to prepare those assumptions, and that those assumptions is one of the fundamental principles in preparing financial statement. Number two, the going concern assessment is management responsibility. Don't forget we talk about going concern assessment that for going concern there are two things: where the management has done their assessment, what should the auditor do, and where the management has not done the assessment. So they now said that the assessment, the going concern assessment, is the responsibility of the management. They have to do it. Number three, the appropriateness to use going concern assumption is the auditor's matter. So now the appropriateness has to do with what the quality of those assessments is now the responsibility of the what of we the auditor. Then number four, ISA 570, which is on going concern, establish the relevant requirements and guidelines after auditors use. Then lastly, the credit uh, the credit crisis. Lastly, the credit crisis and the economic downturn, which may lead to lack of available credit to the entity of all sides. This may affect the entity ability to continue as a going concern. They now said that because of the economic issues, the economic problem, the economic letdown or the downturn of the economy may lead to lack of an organization to have credit to have credit facilities, or which is going to affect their ability to continue as a going concern entity. So this is where we are going to stop for today. Everything that I've explained is well explanatory, is very, very straightforward. That is why you have this material to help you and to align with what you need to know in each of the chapters. So this is where we are going to stop for today. And thank you for, unfortunately we will not have time for questions today. But feel free, if you have any question, put it in our group chat. I'm going to attend to it. So the material is there for you to uh, review. And if I have not gotten the material, please reach out to me in my DM. The material is for you to read and to help you pass your exam. So I wish everybody the best of luck. This is where we are going to stop for today. And on Friday, by God's grace, we will continue and proceed on chapter 10, which is on group audit. Thank you, everybody, for staying through. Thank you. Have a wonderful evening. Good night, everybody.